Hi there! Today we cover when the multinational groups are required to prepare a master file and how the expectations have evolved between 2020 and 2025 based on OECD guidelines. Let's start with the basics. The master file is a standardized documentation that provides a high-level overview of the multinational group, its organization structure, global operations, key value drivers, intangibles ownership and management, financing agreements, and the group's overall transfer pricing policies. According to the OECD transfer pricing guidelines, the master file is required when a multinational group operates in multiple jurisdictions. The group meets the consolidated revenue threshold set by local legislation, often aligned with BEPS Action 13 of €750 million. The jurisdiction in which the entity operates has implemented BEPS Action 13 into national law. Between 2020 and 2025, many countries gradually aligned their domestic rules with the OECD standard. While implementation timing and thresholds vary by country, the master file is generally expected to be prepared no later than 12 months after the end of the fiscal year to which it relates. Since 2023, some jurisdictions have extended the required content to include Pillar Two compliance data, such as effective tax rate calculations and qualitative disclosures about minimum tax mechanisms, as well as sustainability disclosures, especially where they impact value creation and profit allocation across countries. ESG stands for Environmental, Social and Governance. Although not formally required under most national transfer pricing regulations, ESG-related content is increasingly incorporated into master file documentation, particularly by multinational groups with publicly stated sustainability strategies. These disclosures can include climate-related objectives, diversity and inclusion policies, governance frameworks, and influence of ESG factors on operational decision-making and value creation across the supply chain. In the context of Pillar Two, while not all countries explicitly require its inclusion in the master file, many groups choose to reference it when relevant. For example, where the implementation of global minimum tax rules has influenced group structure, intercompany agreements, or effective tax rates, such developments may fall under the requirement to disclose significant business restructuring or financial agreements. According to OECD guidelines and aligned domestic rules, in example Poland's Ministry of Finance Regulation of 2022, information about tax planning, strategies, restructurings, and other material events that affect the group's overall taxation profile should be included in the master file if relevant. Therefore, even though ESG and Pillar Two are not formally mandatory elements in every jurisdiction, their inclusion is becoming a best practice, especially when such factors materially influence the group's transfer pricing policy or its risk profile. It is important to emphasize that the master file is typically prepared by the ultimate parent entity, but local subsidiaries may still be legally obliged to obtain and provide it to local tax authorities upon request, often with a short time frame such as 14 days. Failure to produce the master file in a timely and complete manner may result in tax penalties on increased scrutiny and cross-border audits. Key takeaway: even if your entity is not responsible for creating the master file, you should ensure it's available and aligned with current OECD guidelines. Transfer pricing compliance is becoming increasingly global, and expectations are rising. Thank you for your time.